continues to snowball and get worse and roll downhill, which it seems to be happening right now, we saw protests from customers for these construction projects in front of the builders' head offices, making a big spectacle because they can't close. These builders are essentially going to take their deposits and ruin them financially after the fact and sue them.
Yeah.
And in one case, I even saw, committing arson, burning down the houses or attempting to blow up the houses in that construction project. It didn't happen. I think that is a bit of a foreshadowing as what people will do when they're pushed to the limit, when they're pushed to the edge, and it's really sad to see. Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. The one thing that I have noticed a lot of is that Canadians are super stressed. I'm going around talking to buyers and sellers every day. And the one thing I'm noticing is that they are super, super stressed and not really understanding why things are happening the way that they're happening, and using a lot of weird justifications to try to rationalize all of it. So, for example, well, it's, because this guy down the street sold it for that because he was going through a divorce, and then that's why my house isn't selling very quickly, or something like that. So something that helps them to cope with the reality that that this market's just a little bit soft right now. And I would say when we measure that, obviously I'm talking about the consumption rate. I'm talking about the relationship between sales and the inventory coming onto the market. And it's not like we're in a crazy buyer's market where it's like 8+ months of inventory, but we are in about 5.5 months of inventory, which is a buyer's market, but it's not like a crazy buyer's market yet anyways. And they're just not understanding why it is that they keep seeing on the news that the Bank of Canada is lowering interest rates, and there's this really great consumer confidence that comes with that, just the news of it alone. And then when they go to see what they can actually qualify for, it's like, this rate is sky high. Like, I thought they were lowering interest rates. And I'm really glad that you're here now, because you're actually the first podcast since I've come back that I'm doing in person, not very privileged. And could you just kind of take a second and explain why that is and what's happening, why people are seeing one thing in the news and then seeing another thing when they go to the bank?
Yeah. Why is it like that? Well, because it's not directly related. I think that's the biggest issue. So, and brokers, would try to educate the consumer on sort of the relation between the Bank of Canada rate and the rates that the banks are actually offering to you on the street. But because the relation isn't 100% direct, it creates more confusion than clarity when you try to explain. So I actually found myself running in circles trying to explain the same thing, but some people do understand it. And so let's, I guess, try to make sense of it. So when the Bank of Canada chooses to lower interest rates, which they've done several times in the last year, it is a very macro decision. It's a decision that is the Bank of Canada's decision based on what they have seen happen, based on what's happening now, and based on what they are hoping to affect with this change. Okay. So macro decisions, as we know, like in economics, when you make macro decisions, it takes time for them to take effect, right? Big decisions are not decisions that overnight change the way the economy works. The effect isn't seen immediately. So when we have a lowering of the interest rates, it's a decision that is being made for the benefit of the future, not for the benefit of right now. Okay. Now, there is some changes in the rates that people pay because the Bank of Canada rate, they keep changing with the overnight key rate, with the prime rate. It does affect the variable rate borrowers, and that is a direct relationship. But that's the only direct relationship between the Bank of Canada's decisions on the rate announcement dates and the rate that you're actually paying at the bank is the relationship between what they post as their prime rate and what variable rate you see on your contract. So what affects the fixed rates is the bigger question, because the question is like, well, okay, I understand the variable is affected by the prime, but if I'm a consumer and I'm trying to make sense of what's happening, how can I know if the fixed rate that I'm getting is the lowest that it can be? Well, you don't know, because the fixed rates are based on primarily the price on fixed rates is focused around the bond yields, right? The government bond yields. And when we see bond yields go up, we see fixed rates fall. And when we see bond rates come down, we see fixed rates fall. And these are probably the best signs. Like if you're looking for ways of monitoring what the direction of fixed rates, that's the best place to start. It's not the Bank of Canada, right? Because again, the Bank of Canada decisions are macro decisions. They're not seen immediately. Whereas the bond yield adjustments to what the yield is, right? Because this stuff is getting priced in and out every hour of the day. There is movement, and that movement, as we've seen with, let's say, if we see optimistic outlook on the future, let's say no tariffs. Well, optimistic outlook on the future means the economy should be doing better. If the economy is doing better, there's more jobs. If there are more jobs, there's more spending. If there's more spending, there's more inflation. And so we got to be careful. Okay, so that's one scenario. Well, what if tariffs are back, like Trump did a few times? So the tariffs are back. The economic outlook is, well, things are not looking good in terms of employment. Things are looking good in terms of spending. And we're probably going into a deeper recession if we don't do something. So we got to lower the rates, right? And so this is what you see if you look at the bond yield curve. It's been doing this thing where every time Trump says no tariffs, the bond yield goes, oh, says no tariffs, it goes down. It goes tariffs again, no tariffs. It goes up, tariffs again, it goes down. And it's been doing that. And this is why there has been so much movement in a fixed rate market. Because the threat of the tariffs and the threat of economic ambiguity and economic decline is real, right? Because like if we have full-blown tariffs in Canada, we're losing so much employment to the steel industry, to the car industry, right? Like there's just so much, there's so much connection between the two countries that if that relationship falls apart, we truly are economically in a lot of trouble. And you can see how the banks are preparing for it, because a lot of those industries, like the steel industry and the car manufacturing industry, the workers of those industries have been put under higher scrutiny. This is literally the bank adjusting their policy on the flight to adjust for the ambiguity in this economy, right? So if the customer is, if I'm the consumer and I just listen to all the stuff that I just said, and I'm sitting there and I'm trying to make sense of what's in front of me, what I have to remember is when I'm looking at Bank of Canada decisions, these are macroeconomic decisions that are supposed to echo into the future. They're going to be very careful with them, and they're going to be choosing direction based on macroeconomic activity. When we're talking about the fixed rates, is going to have to do a lot more with our relationship with the states actually than anything else, and how that affects our overall employment rate, spending, and inflation. And so, if we see tightening of that relationship, we will see better rates and worse economy. If we see loosening of that relationship, we'll see worse rates actually, but better economy.
Do you think that this last rate decision to hold from the Bank of Canada was a mistake?
I mean, we were all looking at what was going to happen with that last decision. I think we're all about 50-50 on whether or not they were going to lower the rates or keep them. I think it was about time that they slowed down a little bit because of how much they've done in the last 6 months with the rate decreases, just to see how all of this stuff is going to pan out in the following 2 months. Because the one thing that the Bank of Canada didn't want is they didn't want to overstimulate. And overstimulating could mean like, the real estate market gets a little hot all of a sudden. I'm looking at the commerce is doing that well. The commercial sector, but could maybe also pick up a little bit. They also want to make sure that inflation doesn't get out of control because it was showing its ugly head a few times in the last few months. Right, we're doing okay, I think, overall. I actually would say that this was a prudent decision to hold. I would probably have, if I was Tiff Macklem, I would have probably held rates in the last announcement as well.
That's a really interesting point of view because everyone was pretty upset. And I guess maybe that's the Bank of Canada's job, is to make the unpopular decision.
Yes.
When they need to. And given everything that's kind of transpired over the last little while, I almost felt like I didn't want to make any content about it because it was just changing almost by the day. It was, if not by the hour, about tariffs, no tariffs, tariffs, no tariffs, to the point where it was like, I can't even make content about this right now because it's, by the time I get it out, by the time I get it out, it's going to be completely different. And so now at least we seem to be achieving some kind of homeostasis for a little bit of time, maybe until midsummer time when, that 90-day pause ends, and we'll see what happens. And it seems like that is giving people a little bit of time to just relax. But overall, given where we are now, how do you see the next little while playing out with this market? Because I can see a few things happening, and I actually just did a video on a section of the market that is not readily seen, which is the assignment market.
Oh yeah,
which is completely illiquid at this point. Is basically
strategy.
It's in free fall, and that's something that most people can't see because it's not on MLS.
Yeah.
Having said that, you're on the financing side of that, and I'm sure you must see it on your side where people are trying to get financing for an assignment sale. But I imagine banks can't be excited about that. There's no way that a lender is going to be super excited to fund a deal in the assignment market when they're not even sure if that project is going to close effectively in the way that it was supposed to, because those construction loans may not be paid off if too many people default. So how is it that you are seeing it on your side, where we do have a lot of construction pre-con condo projects going into receivership with this current market? How is that all going to affect downstream everything else? And taking into effect that obviously, like, we don't have a crystal ball here, but I like to get your insider knowledge on things from a lender's perspective.
Absolutely. So the first comment I'm going to make is, let's make sure that everybody understands what an assignment is, right? Because I think there is not a lot of clarity on what an assignment really is. And I think it comes from the problem that people don't fully understand what is it that they sign when they sign the agreement of purchase and sale at the builder's office many, many years ago. Because a lot of people think that when they sign the agreement of purchase and sale, they think they have signed the agreement to buy, that they signed the agreement to buy the unit, but they think that they own it, and there is something to own. While in reality, when you sign the builder contract, you're just buying the right to buy the unit. No, you're not buying the unit yet. The unit is not ready. There's no unit. Right? So the challenge is that when people start comparing an assignment purchase versus a resale purchase, they're forgetting that in an assignment purchase, there are things that you still have to take care of before it's yours. And not only that, but in an assignment purchase, you also have to replace the person that originally held that contract, right? So let's talk about this for a second. So, let's say you bought a condo in 2020 for $500,000. Let's say that condo at some point was worth as much as $600,000, like in the peak of 2022. It's the year 2025. Well, let's say it's just worth the $500,000 that you paid for it in 2020. This is a very cookie cutter example, because if you did buy something in 2019, 2020, you'd probably be looking to dispose of it now through an assignment sale, probably for the same price you paid for in 2018 to 2020, actually, because things rolled back that much. But in an assignment sale, the challenge is that when you are approaching, let's say you're working with Adam, you're approaching an assignment, that you found something that you really like, and you're looking to place an offer. When you're placing that offer, you're placing the offer to buy the contract. So the initial issue with assignment sales, and this is where this is a big hindrance to the whole assignment project. You need to have all the deposits that the person put down. So if they put 20% down, you can't buy an assignment with 5% down payment. It doesn't exist. There's no way to do it. Because the assignment sale means you have to replace the original deposits, 20% that the person was $100,000 and $500,000. Then you got to pay the developmental costs of closing the transaction, because there are things that you have to pay for at the point of closing that go beyond the mortgage and land transfer tax. There is, you could probably comment better on this, but there's developmental levies, municipal levies, educational levies, installation of meters, there's stereo work, there's all this stuff that you got to pay for. And in my experience, it averages out to about 1.5% per condo, 1.5% of the purchase price, in addition to your closing costs. So 1 minute. So if you are buying an assignment, and this is your first purchase, well, first of all, you need to have 20% down or enough to replace the original deposits, because the builder won't let you have that contract. Then you got to have the cash to pay for all these developmental levies and costs at the point of closing, which again, a lot of buyers aren't counting for because they're first-time buyers, don't know any better. And then in addition to all of that, you actually can't close until the building is ready to register with the city, which requires a certain level of occupancy, right? Typically 70%, before the condo can become a corporation, can register as declaration, all that. So it becomes very challenging, because if you're a first-time buyer and you're looking at assignment sales, it is the least, in my opinion, for a first-time buyer, it is the least desirable because it is the most difficult to close. So by virtue of what it is the least desirable asset class, in my opinion, right now on the market, because it comes with those additional stuff and it cuts out all these buyers. And so the assignment market, in my opinion, is suffering so much because the way this resale of the contract works requires a certain amount of down payment that most first-time buyers don't have, and it creates a gap where you have sellers who are looking to sell because they don't want anymore, and you have buyers that just don't exist because they don't have that kind of down payment. And the ones that do, they're looking for other things maybe, or they're maybe looking for a really good deal, right? So what I've been noticing with assignment sales, you will often see like those examples where somebody bought a unit for $500,000 in 2020 or 2019, and they're looking to sell it for that exact same price today just to recover their capital. But they're still challenged by it because the person who is looking to buy it, once they start looking into the assignment contract and making sense of it, the realtor comes in and says, hey, by the way, you need to have all the deposits ready right now because we're going to replace them. Plus, you need all this closing cost capital because it's a pre-construction. It comes with that kind of expense. Plus, you're going to be paying occupancy fees, which is another part of this, right? Until the property is ready for registration, which means you're paying no balance of your mortgage. You're just paying occupancy fees, which are quite significant. And so all these things are against you, and you still have to want to buy it. And I think this is where the assignment market is really messed up, because most buyers are looking at this and they're saying, I don't really know if I want to get involved with this stuff right now because there's all these other things that I just wasn't prepared for. And this is where people get stuck. And so they move from assignments just to resale because they just can't look at that anymore.
Also, it's because you're not actually even sure what those levies will be.
And you're also not sure if the property, like if this is not going to be registered for another 6 months to a year. Well, the challenge is you also don't know how the market is going to behave. What if it's all deflates another 5-10%? I mean, this is a little like, I don't know if I'm speaking into the future, but I hope it doesn't go that bad. But let's say, what if it does decrease a little bit and then you're not closed for another 12 months? And then in 12 months, will it be worth the same amount of money? Will it be worth less? Will you have the money to cover the difference? That's where the challenge comes with assignments too.
Right. And the appraisals on that,
We can't even do an appraisal. There's no sale.
right, don't exist. So you have an unknown tax burden, right, with property taxes, which you are not sure what they're going to be.
Just using 1% of the purchase price as an estimate.
Right, as an estimate.
or 3/4 of 1%, depending on the purchase price.
But your real estate taxes moving forward, you don't know what they're going to be. You don't know yearly. You don't know what the maintenance fees are going to be.
No idea.
You don't know what the levies and charges are going to be, educational, etc. And unless you have it in the contract that those levies are capped,
That's right.
you're kind of in the dark. Even if a builder has capped those levies in the original contract, a lot of them will not honor it on assignment.
Oh, I didn't even know that.
Yeah.
Wow.
Yeah, a lot. So what a lot of people don't understand about the assignment is you are purchasing not just from the original buyer, but still from the builder as well.
Yes.
All of these contracts have a condition upon builder approval. If the builder does not approve the deal, it does not go through. So there are actually 3 people involved, not 2, in this transaction. And so what you'll have is buyer and seller of this contract both agreeing on everything. And then the builder goes, hold on, let me take a look. And then they look through and they go, well, nah, I don't think so. I don't like it because the original deal that I gave you has this and that provision in there. And that's not advantageous to me now. It was back then.
Oh, so they're reneging it.
Yes. And so we're going to only allow this deal to go through if we get certain provisions now reneged on from the original contract. And if you don't like it, too bad, because we still have your deposit and you're still beholden to this deal.
Dirty.
And so builders are doing their customers pretty dirty right now. And so you are seeing a lot of buyers of pre-construction from 2018, 2019, 2020, 2021 a lot of them are walking away from their deposits.
Yeah.
Understanding that the builder's probably going to sue them, resell it, probably for less, sue them for the difference and damages. They understand that and are still choosing to walk away. And then not only are those builders suing their former customers, but they're also suing the realtors that sold their product to those customers because they had paid out half of the commission a lot of the time on inking the deal rather than just on closing. So they're saying, well, you sold this to them, but the deal didn't close. So why am I paying you? And in fact, that first half of the commission that I offered to pay you upon inking the deal, well, we put a provision in our builder standard form, which is, they call it builder standard form, but it's really just every single project has its own builder standard form. It's never standard. And we put a clawback provision in there. So we're now going to sue you for the commission that we paid you. And those agents who haven't sold anything in a while because this market's been pretty dead you're going to sue me now, like let's say for tens of thousands of dollars of money that was paid 4 years ago that I don't have. Right. And so that's,
damn.
Yeah. So thank God that is not a situation I'm in, because I think I've done 2 pre-construction deals my entire career. I've just never really liked it because I don't like how builders negotiate. They're ruthless.
There's some negotiation there. I mean, there is a little bit I've been seeing like lately because builders aren't getting any foot traffic. The strategy I've noticed with a lot of realtors that are approaching builders is to not necessarily negotiate the price down, because builders don't like doing that. They don't like lowering price on their inventory because it's printed. But they have been giving out stupid amounts of builder credit.
And again, how much can you trust that? Builder credit.
It's all marked up, but it's still like it's a thing that I didn't notice. You'll get like 10, 20, 15, 30 grand of builder credit, whereas before you never got any.
Right.
But that's how they're luring
20 grand of builder credit, but your new countertop is going to cost you 15.
Yeah, it's whole.
It kind of gets to a point where I think most consumers should be very wary of going directly to a builder. And a lot of these, in my industry anyways, on the resale side and the pre-construction side, there's basically an almost zero overlap split in the industry between agents that do pre-construction and agents that do resale. Like, for example, I'm an agent that does resale. I've done resale my whole career, almost exclusively. Like I said, I've done 2 deals. Like, that's almost nothing.
Yeah.
There are a lot of agents out there that only did pre-construction. They had sales funnels that worked only for pre-construction, for launches. They were platinum, what's called a platinum an agent who would have direct negotiations with the builders on behalf of their clients, and they'd sell out an entire floor of condos at a time. Or they'd host a seminar and sell out half a building at a time, right? And can you imagine what those clawbacks look like for those agents, right? They had barely sold any pre-construction in the last couple of years, and now they're getting sued for tens of thousands, sometimes hundreds of thousands of dollars.
Well, this is okay. So this is all very rough. Now, we're talking about stuff that's sold in 18, 19, and 20. Can you imagine the stuff we're going to be seeing in next years when the ones that were sold in like 22, like 21, 22 are going to be coming up? Because those are sold for future prices. Builders don't sell units at today's price. That's not how builders work. They sell at future prices because they're expecting for things to level out to a certain number that works for everybody. Works for them, works for the buyer, works for the neighborhood. It is going to be very, very different. Like if in these cases we're seeing, hey, you bought a $500,000 in 2019, great. Guess what? It's still worth $500,000 today, roughly. It's not worth any more, right? Now the real bloodbath is when we're looking at stuff that was sold in 21, 22, where it's like, hey, these are going to be worth X, and the market just went the complete opposite direction.
Right. So now the purchase price is no longer reflective of the current market value, and the interest rate that you thought you were going to be having for a holding cost on that amount of debt has now, let's say,
Double.
tripled or quadrupled.
At least double.
2.5. Right. So, if your holding cost has tripled in a worst case scenario on the amount of debt and the value of the property is going down, like now you can't give it away, right? And you can't close on it.
The one thing that people have been doing just to save this segment is they've been like, you've seen people have seen this probably in the news, like there have been articles talking about how one of the ways that banks have been making these purchases work where there is almost negative value on these pre-con closings is they've been taking collateral on other properties. So they'll do blankets, or they'll, use the equity from a different home to fund a new one. I mean, that's okay. I mean, it saves you from a lawsuit, gives you the ability to sell the property in your own terms, but it's tough. Like I think what we're seeing this year is like one version of it. I think what we'll see in 26 and 27 will be a worse version of it, because I don't think the value will have adjusted to the level that would be enough for those 21, 22 pre-cons to exit okay. I think those might be coming out, and I'm not saying that we're looking like at inventory that's going to come in even at better prices than we have right now. That's not what I'm saying. What I am saying is that the prices that those units were sold for in 21, 22 just are reflective of what they will be sold for when they're ready. That's it. They'll probably make, there'll be quite a bit of a discount there. Again, I'm not saying that it's going to completely tank to below current values. I'm just saying that it just won't be there enough for the original buyer to exit unless they have additional down payment. And that just means there's going to be a whole full horde of buyers who will be in no position to close, and all those units will get relisted by the builder.
So in that case, then what I've been seeing, I think it's kind of always a good place to kind of keep an eye on, because I do think it kind of foreshadows a bit of what the rest of the market's going to be doing in general, is Brampton.
My favorite.
Yeah.
My stomping grounds.
Right. Because there is just an entire section of the market in Brampton where you have seen some of the most egregious pricing, predatory behavior of all kinds, whether that's
mortgage fraud or, builders just kind of making up crazy performas that make no sense to justify price points with construction loans that are insane. All that kind of stuff. We saw a ton of it in Brampton, and what we're now seeing, which I think maybe might be foreshadowing something that we'll see in the rest of the Greater Toronto area if this all, continues to snowball and get worse and roll downhill, which it seems to be happening right now, is we saw protests from customers, for these construction projects, and basically going out in front of the builders' head offices and making a big spectacle because they can't close. These builders are essentially going to take their deposits and ruin them financially after the fact and sue them.
Yeah.
And in one case, I even saw, allegedly a former customer, we don't know who it was, actually, committing arson and burning down the houses or attempting to blow up the houses in that construction project. It didn't happen. So I think that is a bit of a, a foreshadowing as what people will do when they're pushed to the limit, when they're pushed to the edge. And it's really sad to see, unfortunately.
I have to admit, I wasn't paying too much attention to these protests. I did see a little bit of that, just because I just browse Twitter and stuff, and it's hard to hide from the news, but they're all over the place. But I remember that thing you're talking about, not the arson that I missed, but the protests. And there was another funny thing that happened during those protests. I can't remember where I saw this. It was probably all somewhere on Twitter, but somebody was interviewing the people that were at these protests about sort of how they went about buying these properties and sort of how it all went down years before they were due. And there were situations where you had people who clearly did not qualify for the things that they were buying, placing deposits on multiple units, which also tells the story of how real estate used to be sold in the 2010s. Right? In the 2010s, in the wild west of real estate in Toronto, people just were used to looking at their property value a year later and seeing it like a 5-10% increase. And it would get to the point in the 2010s where people were just hoarding as much real estate as they can just for the sake of that 5-10% appreciation on hundreds of thousands of dollars, because to them the monthly payment was almost like a savings account they're paying into for the sake of the bigger return. And so this is, I guess, human nature. We all want to get rich quick, and we all want to be able to benefit from smart financial investments. I mean, it's just human nature. We all want to do well. But I think this also taught everybody a lesson, right? When we look at that behavior from 2010s, and I think anybody who is a consumer without an understanding of the real estate industry inside out was unfortunately the victim of that thinking, because in 2010s there was a period of time when people were really cognizant of the monthly carrying costs of things they were buying, because they were trying to make sure things actually made sense. And at some point people just stopped caring. It was well, what's the biggest I can buy? How many can I buy? 5? Can I buy 4? How many can I buy? I'm what are you going to do with all these? Right? And the idea was that, there's this endless supply of renters and there is endless supply of buyers that's just never going to end. And because it's never going to end, we're just going to keep piling up all this real estate, which we don't have enough of to begin with. We're going to keep piling up and seeing it, somehow it all just works out. So this attitude of, well, it's just all going to come out in the wash anyways. We're just going to just do this now. It will just all work out in the end. I think that's over. Right. And I think this experience with these developments in Brampton, which again, the reason I think that Brampton is a great example of that is because those areas like Brampton or Hamilton, for example, for that matter, right? Those areas do get the greatest benefit of a good market, because again, areas that are not the most desirable in a city get a great boost from a market that does really well, because suddenly everything just kind of gets lifted, right? But it also gets absolutely destroyed in a bad market, and this is where the volatility of the price action is insane. So, these are also the markets where if you were buying into it years, before, and you were used to that appreciation and you've never seen depreciation in real estate, now this is shocking. And people are just not able to wrap their heads around it. But again, going back to those same protests, and then, you start looking through the profiles of the people that are buying these units, and you're realizing that a lot of them didn't qualify for the financing that they were expected to get. So the whole dynamic of those sales was broken from the very beginning. Like, a lot of it was done out of real estate agents trying to make as many sales as they can, and consumers trying to hoard as much real estate because it just seemed like the right thing to do without making sense of what they were doing. I think we're now entering the era in real estate, specifically in Toronto and GTA, where this awakening call that we have all experienced with interest rates increasing to the levels that they've never been seen in years or tens of years, it has taught everybody a lesson to be more cautious and more focused on actual affordability. So, I can't speak for this because I don't deal in that market, and that maybe you can share a little more on this. But if you're talking about like luxury properties, like over $2 million, like that's a segment of the market that used to be frivolous with their money. They just go out and buy things and keep, getting bigger and newer things. That segment is getting smarter about the way they're doing housing, right? They're liquidating properties. They're focusing their debt on their primary residence. They're reducing the cost of expenses because they're feeling it. And at the higher income level, even at the higher income level, it still felt so much when you have all these things that we're going back to the basics and the fundamentals of real estate. Well, is it affordable? Is it? It is? Great. It's not? I don't know. And if that continues, so that actually may reverse the whole way that Torontonians and GTA residents have been thinking about the real estate. So if we're no longer thinking about real estate the way we used to in the 2010s, if it's no longer, how many units can I have? I don't care how much it is per month, but it's more like, hey, can I afford this? We might actually see real estate heal, where there'll be a transfer of title for all these units that are rentals right now. They're not cash flow neutral, or probably cash flow negative every time that the renewal comes up. On these portfolios of 10 to 15 real pieces of real estate for all these people that bought them in the 2010s and 2000s, nature might be healing right now by virtue of this exchange and this awakening moment for the residents of this beautiful province of Ontario may be the thing that we needed, so that people get maybe a little bit more careful with their investments and start diversify. So what an interesting place to be in history right now, right? Especially in this industry in Toronto, in GTA in 2025. So I'm hopeful. I'm actually very hopeful that this is a healing process more than it is just pain. And I think if the capital and the attention of that capital gets reallocated by virtue of this awakening call, and then we actually see more homeowners and less investors in Toronto, well, maybe that's kind of what we needed for the market to heal properly and level itself out.
I couldn't agree more. This returned fundamentals of income versus asset. That is what Toronto real estate has been built on. Is how much is property worth? How much can you afford? And focusing purely on the fundamentals of, is my job secure? Is my job something that is going to comfortably afford payments on this asset? Am I treating it as a home and a tax shelter under the exemption for capital gains on primary residence? And is it, not making up 50% of my gross income, right? Because that's those ratios got stretched. And so
preferably 40% of your gross income.
Right. But they got stretched. A lot of people were going up to that 50 mark, and there's
60 mark too. A lot of people were really pushing it.
Right. And so I think that if we return to those fundamentals, that is what is eventually going to heal the market. And the sections of the market where investors were just foaming at the mouth, went buck wild, are the ones that are getting hit first, namely the downtown condo market.
Yeah.
Decimated right now. I mean, look, you can get a great deal out there right now, but it's not without its risks. That market is in serious trouble. Brampton, right? There was a lot of speculation that went along over there. There was a lot of mortgage fraud that that's Hamilton is getting absolutely destroyed right now for a number of reasons. Is investors were getting really, I think they were getting really sick and tired of trying to purchase something in Toronto for the equity gain, but for like a 3 cap or under sometimes, and looking at the rental rates and going, well, it's not keeping up with this. Is this just an equity bet? I'm getting sick and tired of this. I think I want to, think a little more along the Grant Cardone line and get something that cash flows a little better, which means I need a higher cap rate. And they went out west. They went to Hamilton. They went to Waterloo. They went to those areas where they knew that the tenant profile would not be as good, where they knew that the product would be older, but that the price would be lower and they could cash flow it. So, now, what they didn't anticipate and they didn't plan on, and frankly, nobody saw this coming, unless you were really listening to what Trump was saying, because he was going to put tariffs on Canada. Like, I mean, he was really saying that, and they were not anticipating, they were not listening to him, they're not taking him at his word, is that those steel and aluminum tariffs and those auto tariffs are going to hit Hamilton the hardest. I mean, this is where we have all of those jobs, right? Are all in Hamilton. They're all right
There is another issue with Hamilton and just Ontario in general, and I'll just say it like I'll just put it out what it is. It is that if you are an investor and you were looking for this, which is cash flow, okay, it's smart, good, I like it. Here's what you didn't expect if it's your first one. So let's say you bought a multi-unit in Hamilton, 4-plex, 3-plex, duplex, whatever. Cash flow is great. Let's say on paper it covers itself. Maybe even has a little bit of a profit. These exist. If you look around, they are there. Still till today, by the way. It's not like anything changed. But here's the problem. The landlord and tenant board still takes about 6 months on average to get a hearing.
Oh, that's being generous. Okay, so here's the issue. So I was going to say 10 to 12 months.
So here's the issue. Yeah, cash flow is great. You also live in the one province in Canada where it is virtually impossible to get rid of a bad tenant. So yeah, it cash flows, but if you get a bad tenant or two, you may not be getting paid the money that you need to maintain that building. And this happened times and times again, right? And if this problem was fixed, if the landlord and tenant board problem was fixed, man, like it would bring so much capital back, because I know investors, people who have owned multiplexes, who have pulled out because they can't deal with the ambiguity of this landlord and tenant board situation. They don't want to be waiting for 6 to 12 months to evict a tenant. They need cash flow. They need to maintain their investments. So here's a simple solution. You clean up the landlord and tenant board problems in the situation that it's in, and you get rid of that hearing process, or you reduce the hearing process down to a month, you will have a lot more investors back on the street looking at those same multi-unit properties because they cash flow.
But now that all those jobs are in jeopardy and a lot of people are getting laid off, specifically in Hamilton, Waterloo, Kitchener, you have product that if you did want to get rid of it, if you did want to get out, I mean, it's radioactive. You can't sell it. No one will touch it, right? And so you're either reducing the price to a point where you can make it attractive enough to somebody who's willing to take on that risk, or you're stuck with it.
Well, and this is what's happening, right? So I do deal in housing quite a bit because I do have quite a number of investors, people that work in that area. So I'd noticed this. Here's what's actually happening. You will see commercial buildings, specifically multi-unit or maybe mixed use. So you get like commercial storefronts, upstairs residential, all over Hamilton, like left and right. There's tons of those buildings. Historically, what an interesting setup, right? Like you could have a storefront downstairs, you can run it yourself, you can maybe rent it out to somebody, you could have 2 or 3 residential units upstairs, could generate like 5, 6, 7 grand a month. Fantastic. But then you start appraising it, or you start looking at the cash flow, you start reverse calculating what it's worth based on its income approach. And, these properties maybe at some point were listed for like $1 million, like a few years ago when things were a little different. And you see them going for a few $100,000. Well, the reason is because now the investors who are looking at these, first of all, there's not a lot of buyers for multi-units, right? You need a little more down payment, you need to have some look for it. Like it's not your typical single detached dwelling that everybody wants. It requires a certain type of buyer who understands, who wants that thing. Investors are very careful with landlord and tenant board. They don't love the way that it's acting right now. So not a lot of them are looking. So if you don't have a lot of people looking, now the only ones that are looking for deals. And the ones that are looking for deals are saying, okay, what is this worth based on income approach only? I don't care about your appreciation, your dreams of what it used to be worth. What is it actually able to do? And then what they're doing, they're placing options for whatever. They're getting the appraisals. They're figuring out the income approach. And they're going back to the seller and saying, hey, guess what? I know I paid your X. I can't. The most I can do is this. So an extra $100,000 off the top. If you're okay with me reducing the price, I'll still close it. You don't want it. I'll keep looking.
By the way, that's a fantastic way to negotiate because sorry, my gum got stung. The buy-in psychologically into an offer negotiation and an offer process is a great tool and a great method in my experience. To get people to drop their price. It's funny because this just happened, and I guess to circle back to what you were saying before, and this kind of, I guess I'll dovetail this in a second with how people are negotiating with giving the price a haircut after the fact. Is you mentioned how the luxury market, just people are kind of wising up to and trying to front run a lot of the market instability right now, looking for a better future tomorrow. And I do think you're hitting the nail on the head with that. I do see smart money is getting smarter. And what they're looking for and what they're seeing is reflective in the markets around them. So, for example, you look at high speculative, high volatility markets, whether it's with investors or just, residential speculators that are, looking for asset appreciation. Places like the downtown condo market, Hamilton, Brampton, all those places getting destroyed, right? Because the people were swimming with no bathing suit, and now the tide's gone out, right? So they're standing there naked, and they're getting wrecked. But when you look at the other markets where you had the total debt servicing ratios as a more stable front with kind of this shield around them because of that, where people were just more focused on primary residence, which is just my market. That's where I focus, right? York region, Simcoe, where people are just looking, good, honest to goodness families just looking to settle and build their family. Those markets have been not completely insulated from everything that's happened, but they're doing a heck of a lot better, right? So they've still seen some price dropping happening around them, but nowhere near to the same extent. Especially the entry-level freehold market where there's a lot of demand still. However, where people are trying to get away from condos and condo maintenance fees. However, when it comes to luxury markets and people trying to purchase there, I am seeing a lot of success with people who are negotiating in a very nuanced manner, where you have to keep the line taut without it snapping. And I think that happens over time when you negotiate with people earnestly and strategically at the same time, rather than just coming in a little bit too hot and being viewed as not a serious buyer. You end up getting dismissed of very quickly. And this actually happened to me over the weekend. I got an offer on a property I had listed, and me and my client were talking about it, and it was funny because it was a young guy. Young guy. I mean, I'm a young guy. I'm only 36. I'm not that old, but this guy came in to an open house, and he was, I think, flapping his lips a little too much, just letting on a little too much, and thinking that he's being strategic, where in a negotiation, the less you say, the better. You don't want to give more information for people to base their assumptions off of. And he immediately starts throwing out numbers. I'm not saying anything. I'm just standing there, right? But he just keeps going. And he sends us an offer, and as we were talking about discussing it, we kind of nicknamed him Lowball Lenny. Because what ends up happening is if you come in too hot like that, when you're inexperienced in negotiating real estate deals, is you're quickly and easily dismissed of. Rather than coming in with very little background information, putting forward an earnest offer, it is much easier to get buy-in from seller to the process of negotiating, come back later during a conditional period after due diligence or an inspection or what have you, and give a haircut to the price then. Because at that
Justified haircut.
yes,
This is why I'm asking for.
right. It's because there was information that we didn't know. Now we know it. We're not trying to devalue the property right off the bat, right? And with residential sales, a lot of the time, you better believe it's emotional, right? Buyers are buying a house, but sellers are selling a home most of the time.
Yeah.
And so getting that process going and inching your way into it, it's kind of like dating. Like you don't.
I want kids to die.
Yeah.
I don't know about this.
Yeah, you gotta wine him and dine him first before you take him to bed. You gotta have some game. And so I think a lot of buyers who are looking to take advantage of this market where the smart money is getting smarter is I see a lot of people taking this opportunity to upsize in a lower sales volume environment where the velocity of sales is slower. Because when you're looking to create that upsize, you're looking to create that opportunity for your family, for your primary residence. You're looking to do it in a way where you're mitigating risk. And the way to do that is to do it in an environment where the velocity of sales is much slower, of course, where you can take time to think, where you can go to visit a place a second time, where you have to selection, you can get an inspection, you can take your parents in, you can think about things, you can maybe get a condition on the sale of your current home today.
I've seen that.
And this is a lot of what I'm seeing now. And that's when you said the smart money is getting smarter and that people are consolidating and being a lot more strategic about how they're going about this. I think that that's where I'm really seeing it reflected in today's market. And I hope to see that continue because I look at that and I go, that's a healthier market than what we had before.
Yes. Further to that, I will say even more. Smart money is thinking even one step ahead. What it's doing is it's selling off inventory that is the lower grade inventory. That's like 1-bedroom condos, whatever, like multiplexes in Hamilton, whatever, townhouse here in Oshawa, this and that. Like stuff that's kind of, like entry level anyways. It's not stuff they're going to live in. They bought it because it was investment. It's so counterintuitive to sell those investments now because they are suffering, but they're thinking something else, right? Smart money is thinking, and this requires a little bit of obviously like some perspective and an agent that is able to make sense of all this. But I had seen this. I've seen people who have built a portfolio, maybe 2-3 pieces of property. They'll live in one. They live in one for past 10, 20 years. It's okay. It's not their dream home, but, they did well. They've been working hard and they ran businesses or they worked, their jobs all their lives. And they're kind of like now at a point where they are still working. But I think this is a time for them to either make a move and buy something they're just going to keep as their family home until the rest of the days. Or if they don't do something, this is where they stay. And then they just have to maybe dispose of all their assets, maybe buy something for cash, because the income will eventually dissipate. There will be no income. They're becoming retirees in the next 5 years, for example, right? Is that segment, people who have built wealth on the way out of the workforce, never really bought something they really wanted because they were just too busy. Kids, this, go pay for little Timmy's soccer practice, go do this. Like, the house is a house, everything is here, it's okay. But they're actually looking at this, again, you need a certain type of understanding and an agent who is able to make sense of it. But I had seen those people turn around and say, I'm going to sell all this stuff that I have. I'm going to still live where I am. I'm just going to sell all this stuff. I'm going to take advantage of this depressed market. I know I'm getting murdered on these sales. I'm not making nearly enough what I was supposed to make a few years ago. But I love the understanding that this is the time for me to lose. Let the seller on my next purchase also lose, so we can all sort of win. And that generation that's built that wealth is letting go of multiple properties for the sake of bringing their capital out and buying the one that they really want, maybe for cash, maybe still as down payment in a mortgage. But the one that they live in right now, because it's not the lower grade inventory, they don't really want to sell it just yet. They're thinking of renting this one out, moving into the new one, and eventually selling this one when market picks up.
And it seems like that was the generation that understood what debt really was.
Well, they had a healthy relationship with it.
They had, exactly. That's a good way of putting it. They had a healthy relationship with debt, which I think we've largely just lost.
Well, millennials were taught that that is okay, it's just part of life. Whereas the previous generation was you're not supposed to you're supposed to finish your mortgage by the age 55 or something. It's yeah, where that's most of us don't think of it that way.
No, but they should. It kind of goes back to the old Illy.
Yeah.
Yeah. It kind of goes back to the old Charlie Munger quote, right? Which is, if you're not good with money, you shouldn't take on debt. And if you are good with money, you shouldn't need to take on any debt.
And I think that those words ring true, years after the guy's, what's he been gone, 2 years now?
In a couple of years now, yeah.
And I think it does really ring true in that those people who have spent their time being financially, we're not even talking financially necessarily super savvy, just responsible.
Yeah, responsible is the right word. Responsible, and also it's the generation that didn't have social media, so they didn't feel like they needed to have certain type of things. They didn't feel like they needed to have, the latest Range Rover. They didn't feel like they needed to go on a trip to Bali every 3 months or 6 months. Although I think that's probably healthier than buying a new car. But they didn't need these luxuries and things, whereas this generation is plagued by those things because we can't let go of those niceties and this idea of what success should look like.
Right.
Whereas I look at some of these old timers and I look at them, some of these dudes they'll go and they'll work on a truck or whatever. They'll just wash their hands. They're still wearing the same shirt. They're coming into a meeting with you. They're not bothered by the material things so much, where they will have $2 million in the bank saved up because they wanted their kids to have it, and they're just living off of those investments. But they're still living in a little bungalow somewhere in the middle of Etobicoke, and they've done very minimal renovations just to make sure it's comfortable. And it's sometimes, it makes you wonder, it's why did you work so hard? What did you work so hard for if you're not even using all your money? But that's not how they think. It's no, I have everything. I don't need anything. I'm good. I have a car that works. I don't need to have a payment on it. And I have food. I have my wife is healthy. I have some money left over for my kids when I'm gone. What do I need a new car for?
It's the Instagram consumerism that has kind of plagued our generation, I think, more than any. And what I've also noticed with those people is that the focus on having the latest and greatest and everything has also caused this weird cheapness that I've noticed too, where those same people will step over a quarter to pick up a penny. You know what I mean? It's a very strange kind of thing that I've noticed. And I think, I don't know.
Yeah. Well, because I think the era of social media commoditizes everything from like friendships to attention to items to things. And I think because of that commoditized economy, like millennials and Gen Zers are a lot more emotionally likely to pick something out of convenience, and perhaps what's the right word I'm looking for? Their relationship with that thing, versus being frugal with their money and more strategic about the way they go about the things that they have in their life. Like they'll do stuff and they'll buy things that are completely unnecessary. I'm also at fault for doing that too. I think we all do that, but it's like to what extent, right? So I think so here's what I was gonna say actually to this whole argument about the different generations and how they treat debt and how to treat money. I think it's also because this generation, like millennials and Gen Zers, we don't spend nearly as much time with our parents when we go out. Whereas before, the previous generation would go and like have dinners and spend more time together. Maybe I'm wrong, and I wasn't around when the previous generation was doing their thing, but I don't see a lot of that in families in 2025. And where I do see that, where I see kids still go to see their family, their parents, they still cook together on weekends, maybe, and like not every day, like right or something, the days that they can. They still, go on fishing trips and things. I think that wisdom kind of like it transcends into the next generation, into the children. Whereas the ones that disassociate themselves from the family unit, from their family unit, and they just kind of drift off into this new direction of, I have my own friends, my own things. I do this. I don't have time to go spend time with my parents. I find that actually makes a big impact on how adults behave in their 30s and 40s. To do with spending specifically. Like the healthier the relationship with parents, the more I find that they share a lot of that wisdom. Whereas the further away they are, so keep closer to your parents. That's my 2 cents on a Monday.
Well, you guys heard it here first. That if you want to have, a stable relationship with money and a responsible financial well-being, spend more time with your parents.
Yeah. Cook with them, hang out with them, go and take little oxen trips with them. They'll remind you what matters. I think that is what the point I'm trying to make, because we forget. And the time that you do get spent with your parents and they get to share a little bit of that wisdom and they get to even just tell you some stories. You'll share your challenges, whether they're home purchasing challenges, their work challenges, their personal relationship challenges. And that little bit of, old school wisdom will go a long way in just grounding you and making you feel like you actually have this really healthy feedback loop with people around you. I think it gives you the opportunity to outsource your problems.
Well, I think that is great piece of advice to end off on. As always, super, super grateful to have you in.
Thank you.
And to pick your brain, because you're just a wealth of knowledge and doing this such a long time now. I appreciate it. Thank you. Where can people find you?
Guys, if you'd like to follow, I primarily just keep most of my social media content and most of my thoughts to my Instagram account. So if you'd like to follow, please do follow at The Pocket Broker. And I'd love to have you in the audience. I do share some anecdotal experiences that happen in the industry, and I do try to provide a fair amount of value in terms of just my 2 cents on what's happening. And when you are in this industry, when you're a consumer trying to understand how the industry works, there's no better source with the people who are on the ground and just learning about how they are working and what they think day to day actually gives you a lot of perspective on what's happening out there, because making sense of the news is very difficult.
You heard it there first, folks. Thank you so much, Konstantin. Appreciate you.
Appreciate you.